Dividend cuts are a pain in the butts. Now, when you got higher yielding dividend stocks, they're bound to have dividend cuts. I know that. Well, I didn't know that going in, but I know that halfway through, and I know that now. It's not that big of a deal. It's Zim, that did the dividend cut, but I know it's going to go back up, so I'm not worried about it. I'm still doing pretty good. It was just kind of a blow this morning because I was like, I had my dividends up to like $4,000 a year, and then I look at it this morning and it's like $3,250. I'm like, ah! I knew what it was. I knew I had a dividend cut. So I went in and looked, and it was Zim. So Zim was paying like 50% dividend, and now they're down to 1.5%. So that's where my cut was. I'm sure there was other cuts too, but that's the big one. But you know, they were paying better dividends, and now they're not. But it'll go back up again. I'm not that worried. It was just kind of a blow to my self-esteem this morning when I looked at it. But you know, yeah, you just got to be prepared for that if you're investing in higher yield dividend stocks, or any dividend stocks for that matter. They're only going to pay out what they can afford to pay out. Otherwise, they're going to go belly up. So, you know, don't get too mad at them when they do a dividend cut, because that just means profits are down, and they just can't pay out as much as they would like to. So it's okay. It'll be all right, because it'll go back up. See, it went down 2024. I mean, when I first started, look at this. April of 2022, they paid $17 per share. That was the highest dividend payout that they had. That was amazing. But anyways, you know, it dropped down to 23 cents a share. Then it started going back up. Then it started going back down. But it'll go back up again. So, no big deal. I do like Zim. I think on average they pay about, well, I don't know, what do they pay on average? On average, with Zim, I made about 30%. So that's still pretty good. On average, 30%. Can't get that at the bank. So I'm gonna still keep putting money in Zim. It'll take me about 4 years to get basically 100% return on my investment, and then some. But you know, that's okay. I'm hoping to retire in 5 to 10, so I'll just keep putting more money in, and Zim and BITO will help me pay for my other dividend stocks that might not pay as much. Now see, BITO says they're paying 71% dividend, but so far my total profit's only been like 12%, 11.5%. Oh, that's considering that the stock is down as well. So it would have been more like 15, almost 20% if the stock was up. But anyway. So right now the best paying dividend stocks, the top three, is BITO, EETH, and BTF. Unless there's one I don't know about. This one's paying about 20-25%. But their stock is 21%. But their stock is way down. So I'm not sure what their earnings per share is, but I'm pretty sure these guys are kind of upside down on their portfolio. Although, on average, I'm still making about 13%, so I'm still doing pretty good. I did back off on investing in these guys because the stock looks a little risky. But EETH, BTF, and BITO and ZEM seem pretty stable. Now, I'm investing in a bunch of different stocks. Basically what I do is trying to invest in anything that pays more than the interest rate on my debt. So if the yield is more than 20%, then that's what I'm trying to invest in. I do have stuff that pays less than that, but my main focus is things that pay more than the interest rate. You know, the yield is higher than the interest rate on my credit card. I got one credit card paid down. I'm working on getting the other one paid down, and then I'll have my pickup truck, and that's like 14%. So then I'll be investing in things that pay more than 14%. And once I get my pickup truck paid off, then it'll just have my mortgage, and that's about 7%. So then I'll just be investing in things that pay more than 7%. But anyhow, and what I do is I just throw in $20 and I wait. If it pays a dividend, then I look at the yield. If it's 15%, I throw in $15. If the stock is up over the 5 years, then I'll throw in $150. It's like right here, EETH, their stock is up over the last 5 years. So when they pay the dividend, I'll look at the dividend yield, which it is 47.63%. So if the stock was down, I'd only throw in $48. But since the stock is up, if I have $480 to put in, I will. If I don't, then I'll just put in as much as I can. And that's how I grow my portfolio. So if the stock's up overall, it doesn't look like it's gonna crash or anything scary. Not overall, but within the last 5 years. If it's up within the last 5 years, then I'll throw a 0 on it, because then it's pretty stable. But if it's down over the last 5 years, then I might not put as much in. It just depends. This does not tell me what their earnings per share are. Let me see. It also doesn't tell me what their PE ratio is. So I'm not really good at reading the PE ratio, but I am basically, if the earnings per share is higher than the dividend that they're paying out, then it's a stable investment, or at least that's one factor. If the earnings per share is less than the dividend they're paying out, then they're basically losing money, because they're paying us more than they're making. So it's like, where are they getting that money from? So yeah. So that's not a healthy habit. It's kind of like our government spending more money than they're bringing in, and then they're going into a multi-trillion-dollar deficit. You know, we can't do that in business. Can't really do that in government either, but you know, they think they can get away with it. Well, businesses, they have a harder time getting away with it unless they got government bailouts, which is why I think KLIP is still maybe a stable stock, because it's a Chinese internet company. I gotta look more into it, but it might be government backed, and that might be why it hasn't collapsed. Because it looks like it's dying. But that being said, in the last year, it started going back up a little bit. So, or I should say the last 6 months. But we'll see. You know, we'll see. As long as it's making me more money than I'm spending, then I'm happy. So I've got almost $1,500 in. It's down $60, but I've made $283. So far I'm making money off of it. I'm not losing. So that's what's most important. But anyway, I know other investors, you know, badmouth high-yielding dividend stocks because of dividend cuts, and it is maybe a bad thing. But if you are aware of it going in, you're more prepared so that you don't get burnout. Because see, like, one of the things they say about high yield dividend investors is that they'll put all their eggs in these big baskets, if you will, and then they get a dividend cut, and then they get burnt out, lose interest, and say, forget all this this ain't worth it. You know, where's my good return? You know, it's just like when I was investing in Zim a couple years ago, and hang on. Oh, okay. When I was investing in Zim before, and they were paying a higher yield, I got my brother, girlfriend, and dad investing in Zim. And okay, yeah, it was right about, it was in 2024 when the stock went way down, and you can see my little orange circle there. That's when I cashed out. Well, Zim was down big time, and they didn't pay a dividend for over a year. We was all freaking out. And then whenever they did start paying a dividend, they did a dividend cut and was down to 1%. And that's when I cashed out, because the stock went back up. I cashed out. And then I ended up getting the money that I should have made on my dividends on the cash value side. But anyway, everybody else freaked out and was like, forget it. You know, my dad freaked out, my girlfriend freaked out, my brother freaked out. I was kind of freaking out too. But once they broke even, they just cashed out so they didn't lose their money. If they would have stayed in, they would have made more money, but at least they didn't lose any money. But that dividend cut would have ruined a lot of people, being like, this is a ripoff, you know. And I was a little disappointed too.
Half a mile. Take the first exit on the right onto 327 toward Wayland.
Hang on.
Speed limit reduced ahead.
Oh, okay. Why is it telling me to? Oh, this is a glitch with my GPS. It always tells me to jump off on this exit and then jump back on.
Speed warning. Speed border ahead.
Okay. Anyways. So yeah. So don't get discouraged when you get a dividend cut. Look at their history. Will it go back up? Like Zim. Yeah. This quarter we're gonna get a dividend cut at 1%, but it'll probably go back up. Next quarter. It just depends on how much money they're making. So yeah, like you said, right here it was 23 cents. Where'd it go? There it is. 23 cents in 2024. But then it went back up to 93 cents. And then it went back up to 365. So yeah, it'll get better. It'll go back up. It may not go back up to $17, but on average, I'd say it's paying about maybe $4 per share on average, 3 or 4. So how many shares do I have? I have 107 again. I think that's what I had before. Been trying to build my portfolio back up to where it was in 2023. But anyways, so 107 107 times 3 107 realistically, I should be making about $300 a quarter if I just keep that money in there and don't take it out or don't put any more in. I'll be putting more in, so it's gonna grow. But on average, it's gonna make me about $3 a share every quarter. So not too bad, not too bad. Times 4, that's $1,200 a year. So that's about average. So just those 100 shares, 107 shares are gonna basically pay me 1 week's income per year. I just gotta do that 52 more times. If I just dump all my money into Zim, you know, I'll be alright. However, you don't want to put all your eggs in one basket. So that's why I'm spreading everything out. And my average average yield is 20%. So my dividend growth over the last 5 years is 1.4. Not too bad. It was probably better until I got that dividend cut today. But once Zim ups their dividend again, and that 1.4 will go back up.
Entering Iowa.
Ugh. But anyways, I'm still doing pretty good. I can't complain. Yeah, diversify your portfolio. You can have some high yielding dividend stocks, but also have some more stable, lower yielding dividend stocks as well. Me personally, I probably won't invest too much in anything that pays less than 10%. But that's because I probably only have another 10, 20 years, 30 tops. So I want to retire in about 10 years, 5 to 10 years. So anything under 10% will take me more than 10 years to get a return on my investment. And so yeah, I'm mostly going to be investing in things that pay more than 10% because I'm playing catch up. I didn't know about this stuff when I was younger. Nobody taught me. I had to figure it out for myself. So that's why I'm doing these videos for the younger generation, like my nephew. I got him started and then he cashed everything out. And my brother said something to him about it. He's like, well, it's only paying me $1. Well, that's only because you got maybe 20, 30 bucks in there. You know, if you had a couple $100 in there, it might be paying you $20 or $10 every month, every quarter. You know, you keep putting more money in, you keep getting more money out. And they were higher yielding dividend stocks. I had him in, of course, he can only use Cash App, but I had him in ARR, which that stock is down, but it's still paying a decent dividend. Let's go to Cash App. I'm not using Cash App so much anymore because it doesn't work with Snowball. I gotta manually do everything. So I'm using Cash App mostly for just day trading now. still getting dividends. But when the stock goes up, I'm going to basically cash it out. But I'll still get dividends until the stock goes up. But I'm pretty much treating everything like day trade now and cash out. Strange. I can't see my nephew's profile anymore. Oh, here he is. Took a minute for it to propagate. So yeah, he pretty much cashed everything out except for his $30 savings. He's been blowing all of his money on stupid stuff. But he had $600 at one time, and if he left that $600 in there, it basically would have paid his cell phone bill every month. He wouldn't have to worry about paying his cell phone bill, coming up with the money for his cell phone bill. I think that's as far back as I can see. But anyways, yeah, he cashed everything out. And now he's got no passive income. He's spending money like a woman, or trying to. All these apps, all these games, blowing money. But anyhow, you know, I'm trying to educate people like my nephew who still have time. You know, if I would have known this when I was his age, I'd be retired by now. But nobody told me, nobody taught me. You know, I've been doing my own homework on stuff, business, money, finances, blah blah blah. But nobody really talked about this stuff back in the day. I mean, yeah, I heard about stocks. I heard about, you know, investing in the stocks and having an IRA and a 401k and all that stuff. But I didn't really know much about it. Nobody really explained it to me. I just thought, you know, day trading like everybody else probably typically thinks. I didn't know anything about dividends. I knew about IRAs and 401ks. 401ks, from what I understand, are a joke. The only time you want to do a 401k is if the company matches a certain percentage, and so basically you only put in the percentage that the company matches. That way you get 100% return on your investment. And then when you quit or retire, you roll that over into your IRA. And then you want to have a Roth IRA, because that's going to give you the best return on your investment. Plus you can use it sooner. You can use it at age 59, 60. And it's tax-free when you retire. My Roth IRA is making about 15%. So that's a good investment. But you should also be doing dividend stocks on the side. That way, maybe you can retire early. And then when you hit 59, 60, boom, you got that extra money from your IRA. Tax-free. With dividends, you still got to pay taxes. Unless it's coming out of the Roth IRA, then you don't got to pay taxes on it. So, yeah. So basically what I'm trying to do, I got my Roth IRA up to like 19,000, almost 20,000. So I'm trying to get this up to the same amount as my IRA. and then I'm going to start growing them side by side in unison. So whichever one has the smaller number, that's the one I'm going to put more money into. So that way, it's like I said, I only got about 10 more years. I'm 51 now, so in about 10 years, I'll hopefully be collecting retirement from my IRA and my dividend stocks. So, but like I said, the IRA is only paying 15%, where here I'm making 20, 25. But as I start investing in other stocks that pay less than the interest rate on my credit card, then my average interest rate is going to go, or my average yield is going to go down. So right now it's only high because I'm investing more in the higher yielding dividend stocks. But as I invest in some of the lower ones later on, then my yield's going to go down. But I'm just trying to get a jump start right now. But that being said, there are some high yielding dividend stocks that don't pay a dividend, so you got to be careful. That's why I only put in $20 to start, and I wait till I get a dividend. When I get a dividend, I look at the yield, and then that's how much money I put in. I look at the yield, I look at the 5-year growth, and so like BITO, it's got a yield of 71%, but the stock is down for the last 5 years. So I'll only throw in $71. If the stock had been up for the last 5 years, then I would throw in $710. But since the stock's down, then yeah, I'm not gonna take that big risk. My brother, on the other hand, he threw in 12 grand in the BITO, and now he's making almost $1,000 a month in dividends. My brother's like, go big or go home. I'm like, yeah, I don't know about that. But I kind of want to balance out my portfolio, because what if BITO goes bankrupt or whatever, or goes out? Then I'm going to lose $2 grand. However, I won't totally lose $2 grand. I've already made 300. So every month that I get paid, that'll make that stock less of a risk, because once I get my dividends to where it's over $2,000 or $2,280, once I get my dividends over that, then it's all profit. And then I'm like, okay, cool. If it goes bankrupt or whatever, if it bottoms out, no big deal. I've already made all my money back. And then any money I make after that is 100% profit. So between now and then, it's high risk. But once I reach that point, then it's no longer high risk. And my brother put in 12 grand, so it's going to take him a little over a year, maybe a year and a half, before he breaks even. And then after that, boom, it's all cash money after that. So it's no more risk. So that's what it's all about. You just got to get past that risk stage, and then it becomes free money. So some people say that dividend stocks are free money. And it's not exactly free money, but like I said, once your total profit exceeds your cost basis then it's free money. Then it's money in the bank. So you just got to get to that point. Until then, yeah, you're taking a risk. But after then, boom, you're golden. Alright, anyways, I'm starting to get hoarse. So I'm going to jump off here. But just keep that in mind when you get a dividend cut. And that's why you want to balance out your portfolio. That way, if one stock cuts their dividend, well, it doesn't really hurt you too much. I lost 5%, but that's just for this month or this quarter. It'll go back up later. So I'm gonna put some more money when I get paid this week. I'm gonna put some more money into BTF because it's paying about 44%. So I'm gonna bring that up. But first, what I'll do is I'll go in and I'll look at all my stocks that I've already paid a dividend for this week, and then anything that I haven't already reinvested in or whatever. I mean, basically, so I got some dividend. I got a dividend today, not much, a couple pennies, and then I'll get a dividend tomorrow. And then I'll have my money available Monday to reinvest. So I'll go into the stocks that pay the dividend. I'll reinvest in those first. And then whatever I have left over, I'll probably put that into, where to go? BTF. BTF.
Police station ahead.
Is paying out in September. I don't know what the X date is. Oh. Yeah, I do. No, I don't. Okay. Okay. Oh, wait. I guess it already passed. That doesn't make sense. Hang on. June 18th, June 17th. Okay, so the X date will be around June 20th or September 25th. We'll say September 20th to be safe. So as long as I got the money in there before then, I'll still be at the 12 cents per share. So yeah. Right now I have 17, almost 18 shares. I should probably just wait until I get my dividend to put money in. But trying to get my higher yielding dividend stocks up a little bit, especially now that I got that dividend cut. But it is down for the last 5 years, so I should be careful not to put too much money in there. Maybe I won't. Maybe I'll wait. Maybe I'll wait. EETH is doing really good. It's up for the last 5 years. It's got a 47% return on your investment. On average, I'm making 22% almost. Dividend yield, 46%. That's my average. 47 is the average right now. So, not doing too bad. This is different and weird. Oh, this is paying out August. Oh, okay. And last payout was August 7th. My next payment's gonna be $35. Next payout doesn't say when it's gonna be. That was probably the last payout, $35. But anyway, let's go back and look. It's paying $34 per share. But I wish that it told us what the earnings per share was in this Snowball app. But it don't. Anyways. Yeah. Yeah, I'm eager to get my dividends up, but I gotta be careful not to get too hasty. Because like I said, I just dumped a bunch of money into Zim, and then I got a dividend cut. So, I just need to stick to protocol, and that is just hold on to my money. I'm getting 4% return on my investment from Robinhood, just sitting in the cash account. So, just sit on it, sit on the money, collect the 4% until these people pay their dividends, and then drop the money in there instead of getting too hasty. But, you know, yeah. I'm just trying to catch up with my brother now. That's my problem. My brother was trying to catch up with me because I got more real estate than he does, but he's got more dividends than I do. So now I'm trying to catch my dividends up. So I'm kind of in competition with my brother, but not really. I guess we're both in competition with each other to a degree. But I guess he's a little bit jealous of me because I got more real estate than he does. But my real estate's not making me money. That's the problem. I mean, it can. As long as I got livestock on there, it can and will make me money in the future. But right now, it's not really making me money. It's costing me money. So my main focus now is dividend stocks. Get my dividends up, to where they're making me more money than my job, then I can focus on the farm and get my farm and my land to making me more money than my job. And then I can quit, retire. Actually, I'll probably quit and retire whenever my dividends exceed my income. But anyway, now I'm really getting hoarse. So we'll talk to you later. Good luck. Follow the Minority Mindset guy. He's like I call him the Indian Guru guy. And he's probably my favorite stock guy. Gen X Dividend Investor, he's pretty good, and then Dividend Bull is good too. Those are my three main people, but I really like the Minority Mindset the best. He's really my favorite. So there might be other good ones out there, I'm sure, but I'm not a guru yet. I'm just trying to give people my perspective, what I'm doing, how I'm growing mine, and what happens along the way. Trying to encourage the younger generation to get started before it's too late. And yeah, that's about it. So, alright, party on. Good luck.